Hey everyone, welcome back to Corporate Decoder. Today we're diving into Stanley Black & Decker's latest annual report. Buckle up because even though it's about tools and fasteners, there are a few surprises hidden inside. Let's see if their performance was screwed up or hammered down. Stanley Black & Decker, the company behind DeWalt, Craftsman and Black plus Decker, had a pretty busy year. While they're known for tools, they also provide engineered fastening solutions. In 2024, their total sales were about $15.4 billion, with most of that coming from the United States. The company operates in two main areas, tools and outdoor and industrial. But here's the thing, Stanley Black & Decker has been selling off parts of its business. They sold their security solutions, automatic doors, oil and gas, and even their infrastructure business. Why? They want to focus on what they do best, tools, outdoor equipment, and those engineered fasteners, the things that hold everything together. To make things even better, they started a big cost-cutting plan to save $2 billion by 2025. They want to get their profit margins back up to where they used to be, over 35%. The plan involves making the company simpler, streamlining how they make and ship products, and focusing cash flow and inventory optimization. It's a way of getting leaner and meaner. What about the shareholders? Stanley Black & Decker plans to give extra money back to shareholders by increasing their dividend. That is the quarterly amount they give shareholders and buying back shares. But for now, they will focus on paying down debt and investing in the core business. It's a balancing act between rewarding investors and setting up the company for future growth. Let's break down how each part of the company performed. The tools and outdoor segment, which includes the big brands like DeWalt and Craftsman, brought in about $13.3 billion, making up most of the sales. The industrial segment made $2.1 billion, which includes the engineered fastening business. Stanley Black & Decker owns a ton of trademarks. We're talking DeWalt, Craftsman, Stanley, My-Det, the list goes on and on. For the industrial division, big trademarks include Stanley and Elson and more. There are several risk factors that need to be taken into account. Sourcing goods from certain regions like South Korea, China, and Taiwan is risky because potential tensions or conflicts could disrupt the supply chain. It's harder to make and deliver products if you cannot get parts in time or have to pay more for them. Changes in trade rules and tariffs create big challenges. The company imports materials and sells products across many countries, so any new quotas, duties, or trade restrictions could hurt their profits. Trade policy is an important variable for the company. Recessions are tough. People buy fewer tools when the economy slows down. Interest rates go up and down, influencing customer spending, the state of the economy, and therefore consumer confidence has an important influence on sales. There are also significant financial risks, including the fact that the company uses financial arrangements to control risk, but if they contract with defaults, that could have ramifications. The company is exposed to the counterparty risk of the various institutions it relies on, and those could cause large losses. The annual report also talks about cybersecurity risks that have increased a lot in the modern technology-driven era. It also confirms they have processes in place to manage cybersecurity threats and data privacy laws, as well as the protection of their brand image. They have an insider trading policy to prevent key employees from trading the company's stock based on private information. Let's talk about who's in charge. Donald Allen Jr. is the president and CEO. Patrick Hallinan is the chief financial officer. Also, there was a change in leadership as Deborah Wintner became the senior vice president and chief human resources officer in August. Now, for some legal trouble, the Consumer Product Safety Commission might fine the company around $32 million for allegedly not reporting issues with some products quickly enough. There's also a class action lawsuit claiming the company made false statements about product demand. The defendants intend to vigorously defend the action, whatever that means. Here's what they have in mind for the coming year, though it's important to note that actual performance is not guaranteed and may be impacted by factors outside their control. The company expects earnings per share on an adjusted basis to be between $5.25 and $5.75 for 2025 and expects free cash flow between $650 million and $850 million. So what's the bottom line here? Stanley Black & Decker is going through a big shift, focusing on its core strengths and cutting costs. They are in the middle of transforming, and the success of those transformation efforts has yet to be fully seen. Stanley Black & Decker is aiming for solid long-term growth. They are shooting for mid-single-digit increases in revenue, adjusted gross margins of over 35%, and strong cash flow. Management believes that these benchmarks are within reach. However, if they fail to maintain these goals, they may have difficulty with debt covenants. Several factors could impact future performance for the company. One is the company's success in adapting to shifting market trends, like increased consumer demand for energy-efficient products focused on electrification. It's essential to stay ahead of the curve. It is also important for Stanley Black & Decker to protect their brand image. Here's the big question: should you invest? Based on their strategic direction, cost-cutting efforts, the strength of the housing economy, and assuming they achieve the intended efficiencies of the transformation, a reasonable target price range would be $100, $10, $125. The company may be worth considering based on its market presence and ongoing transformation, but you must be willing to incur risk. If you found this analysis helpful, please subscribe, like, and comment below. Until next time, this is Corporate Decoder, keeping Wall Street transparent.